Mm. Hi everyone, and welcome to the practical workshop for beginners with OctaFX. My name is Ambrose Ebuka, and once in a month we hold this online workshop for beginner traders to help you guys improve your trading skills. Now you're going to learn a lot from me. You gain new knowledge, and we're also going to have a practical session where we'd analyze some pairs and just discuss and put what we've learned into practice, so that in the end you can be able to make the best profitable trading decisions for yourself. Before we even get started, you can go ahead and let me know your name and where you're watching me from in the comments. You can also go ahead to let me know if if this is your first time actually, participating in an OctaFX workshop or an OctaFX webinar. Let me know in the comments. And in the course of the practical session, if you have, some pairs that you want me to implement what you've learned on, then you can also let me know as well, and we'll do that. So this is going to be an interesting practical workshop. It's going to be a 2-hour practical workshop, so you can just go ahead and get yourself a chill drink and a popcorn and relax. And also, while you do that, so you get yourself a note and a pen so you can jot things down. So as you let me know your name and where you're watching me from, I just want to quickly talk to you guys about the promo code that you can use to double your deposit. And the promo code is Ambrose E100. You can scan the QR code to apply the promo code, or you follow the link in the video description, or you can manually just, type in Ambrose E100 when you want to make a deposit, and you'd get 100% bonus to that deposit. The promo code is valid until tomorrow, 31st May 2023. So you can hurry up and take advantage of this promo code for more profitable trading. Did I almost cover the camera right now? All right, Cynthia from South Africa. This is my first time. We also have another person, Mooncake, since it's his first time as well. Welcome, guys. Welcome. It's going to be an interesting one. You can always use the chat box or the comment section to ask me questions in the course of this webinar. All right, let's get started. Any opinion, news, research, prices, analysis, or other information discussed in this training or linked to this presentation are provided as general market commentary and do not constitute investment advice. So we're going to be looking at a few things. We're going to look at market analysis, and that includes, fundamental analysis, technical analysis, and I'll just give you guys a briefing on sentimental analysis as well. We're also going to look at how you can apply risk management to your trading, and would have a practical session where we put all these things into, just put it together to kind of perceive the market and understand market structure. And I'll wrap up with diversifying your investment portfolio. Just look at how you can use the multiple asset classes and investment options with OctaFX to diversify your portfolio and increase your income. So we're going to start with market analysis, and like I said, technical and fundamental are the mostly used. We also have sentimental. I'll just give you guys a briefing on that. But what is market analysis? Market analysis refers to the systematic examination and assessment of prevailing historical market conditions with the aim of making informed trading decisions regarding buying and selling of assets. The present study entails the collection and examination of data pertaining to diverse determinants that impact the market, including but not limited to economic indicators, market trends, business growth, and investor sentiment. Now, the examination of market conditions can be conducted through a range of methodologies such as technical, which we're going to discuss, fundamental, and sentimental analysis. The objective of conducting, and this is very important, guys, so pay attention. The objective of conducting market analysis is to recognize and comprehend trends and patterns that can be utilized to make well-informed trading decisions. Guys, trading is all about making well-informed trading decisions. The money you get from trading as a profit is a reward of a good trade, right? Of a trade that was placed with good strategy, or a trade that was placed with a well informed analysis or well-informed zone and all that, so that's what it's all about. And you need to understand exactly how you can understand what's going on, or you need to understand exactly how you can take advantage of the strength and weaknesses of different countries, how it affects their currencies, and you merge that with technical analysis, and you make beautiful trading decisions, right? So we're going to look at all that as well. I'd like to start with fundamental analysis, which is basically trading the news, looking at economic events and understanding how the reports or the results of these economic events can impact a country's domestic currency. So fundamental analysis examines a range of economic and financial variables that influence the value of a currency, including interest rates, inflation, political developments, and release of macroeconomic data. Traders who employ fundamental analysis scrutinize economic indicators such as gross domestic product, consumer price index, employment reports, which is an NFP for the United States, and central bank policy decisions in order to ascertain the potency or fragility of a currency. Through the assessment of these underlying elements, traders can make well-informed determinations regarding the trajectory of a currency pair's exchange rate and establish long-term trading techniques. Guys, the key word here is long-term trading techniques, and it's that way because as you're trading, you want to be trading for a long time, right? You want to, regardless of the duration or the time interval you want to be trading for. The main thing is to make sure that when you're trading, you're comfortable and confident with the trading decision you're making. And for you to be comfortable with that and confident in your trading decision, then you need to establish a proper trading technique that can give you that confidence. You don't want to start clicking buy and sells in the markets randomly, right? We're going to look at all that, and at the end of this webinar, you're going to be able to create a working strategy for yourself that would help you make well-informed trading decisions. Now we're going to look at some key events in the economic calendar, and this is still under fundamental analysis. And we have the NFP, which is the first one. NFP is also known as non-farm payroll. It's a part of a monthly report that represents how many people are employed in the United States in manufacturing, construction, and goods companies or goods sectors. The NFP is released every first Friday of the month at 8 a.m. Eastern time. So regardless of what your time zone is, you can do the conversion. 8 a.m. Eastern time. What is it? How many hours do I need to add? How many hours do I need to subtract to get what time it's going to be in my country? And you get the exact time. The NFP reports would be released in your own time zone. So it's 8:30 a.m. Eastern time, and you can do the conversion to get that as well. GDP is also known as gross domestic product. It's the total value of the goods and services produced in a country over a specified period. The GDP does not include sales of used goods, or used goods are also called second-hand goods, illegal activities, black markets, non-monetary compensated work, and unpaid work. The GDP is released during the final week of the month, and the first estimate is released during the final week of the month, immediately following the end of a calendar quarter. The third one we're going to have, which is also an important economic event, also known as the inflation indicator as well, is called CPI, Consumer Price Index. Now, the CPI is an index released by the US Bureau of Labor Statistics. We normally call it BLS. So when you see abbreviations like BLS in financial articles or videos, you know that BLS is being referred to as the Bureau of Labor Statistics. And the index measures the change in price of a representative basket of goods and services such as food, energy, housing, clothing, transportation, medical care, and education. It's also known as the Retail Price Index or Cost of Living Index. Now, the CPI does not include investment items such as stocks, bonds, real estate, and life insurance. The CPI is released at 8:30 a.m. Eastern Time on the second or third week following the month being covered. Now we also have the Fed, right? And the Fed is also known as the Federal Reserve System or the Federal Reserve, and is the central bank of the United States. So we're going to go in depth to understanding the structure of the Fed, because that's going to help you understand exactly what to expect from, you know, the meetings that will be held by FOMC. If this is confusing, don't worry, we're going to go into an in-depth explanation in the next slide. But the Fed is the central bank of the United States. It was created by the US Congress in 1913 to provide the US with a safer and stable monetary and financial system. All right. Monetary policy is set by the FOMC, which is also known as Federal Open Markets Committee, and it oversees the operations or the open market operations of the Federal Reserve System. And this is what the structure of the Fed looks like. So we have the Federal Reserve System at the top, and we have three key entities under the Federal Reserve System, which is the Federal Reserve Board of Governors, the 12 Federal Reserve Banks, and the FOMC, the Federal Open Market Committee. Now, the FOMC meets 8 times a year, holding a meeting once every 6 weeks. And at each meeting, the FOMC or the committee will just discuss, you know, the outlook for the US economy and monetary policy options as well. And they also have 5 key functions, right? And the first one is to conduct the nation's monetary policy. The second one is to help maintain the stability of the financial system. The third one is to supervise and regulate financial institutions. Fourth one is to foster payment and settlement system safety and efficiency. Fifth one is promoting or to promote consumer protection and community development. But guys, it's really important that you just kind of have it at the back of your mind that the Fed was created to provide the US with a safer and a stable monetary and financial system, and also to preserve the purchasing power of the US dollar. That's one of the goals of the Feds. Okay, I'm seeing Michael from Abuja. He said it's his second time watching your video. So welcome back. I believe that after every video you get some insights and you get added knowledge that would improve your trading abilities or trading skills. So it's important that you always stay updated with the trend, stay updated with these videos so you can understand the overall trend of the market and, you know, make profitable trading decisions as a result of that. Okay, so this is basically what an economic calendar looks like, because we've looked at some key events. Let me just go back. Yeah, we've looked at some key events, NFP, we've looked at NFP, GDP, CPI, Fed. And remember, the Fed or the FOMC meets 8 times a year, holding a meeting once every 6 weeks. So you need to understand or identify the exact time they will be meeting. You need to identify the exact time NFP will be released. You need to identify the reports, you know, the results. What was the previous reports? What's the forecast? What's the actual results? You know, what's the impact of this news? Is it a high impact news, or is it a low impact news or medium impact? This is what it looks like. And I'm going to give you guys, you know, a website where you can get economic events or reports from economic events, and that would be the OctaFX economic calendar. So when you just go to OctaFX.com, you want to go to the menu. If you're using a mobile phone, you want to go to the menu. You want to go to analysis and education, and under analysis and education, you want to go to analytics, and you click on economic calendar. Now the economic calendar consists of various economic events and reports for various currencies, right? So today you see that we don't really have much, and I think if I change the filter to include medium and low impact events, then we're going to have some extra events as well. So you can take advantage of this economic calendar to know, you know, what's going on with unemployment rates in different countries, what's going on with the GDP, you know, just basically understand what's happening economically in different currencies. You see that the South African rand has also been included as well, and some extra currencies, you know, that you can take advantage of. I prefer to just keep it at medium and high, or sometimes just only high, because as the name goes, it brings about high impact volatility or high volatility to the market. But for, you know, knowledge purposes, to just get extra knowledge, you can utilize low impact, medium impact as a beginner trader and just learn a few things about, these events. So you can utilize this, and yeah, that would help in understanding the strength and weaknesses of, different currencies, different economies, and you can now merge that with technical analysis and improve your trading. Okay, we're going back to how to use fundamental analysis in trading. Now, you understand that fundamental analysis has to do with trading the news, looking out for economic events and looking out for the strength and weakness of currencies. Now, how do you use fundamental analysis in trading? Because it's not just going to be about, oh, okay, unemployment rate is low, which means that the currency is good. If the unemployment rate is low, then that's good for the currency. Remember, you're trading two currencies, right? You're trading a base and a quote currency. So you also have to look at what's going on with the quote currency, both currencies actually, to identify, strength and weakness and do your comparison, right? So the first thing you want to do is to look out for the events of the week or the day. And this is the first step in how to use fundamental analysis, but I just like to call it the first step in general analysis, because when you wake up in the morning and you want to, or in the afternoon, I don't know what time you guys wake up, but when you wake up and you want to, or when you just want to analyze the markets, you don't just want to go straight to your charts. I mean, you want to identify what's going on economically so that you don't just do analysis on the charts and governor just comes and talks about, or a central bank governor here just comes and talks about currency, and the market starts to move in the opposite direction from the one that you set. So you want to look out for the events of the day or the week, identify what's going on. Do we have any reports today? Do we have what's the calendar looking like today? What am I expecting? Any high impact news? Just so that you understand what time you need to look at the market. So for example, if you're going to have a high impact news that would be released at 2:30 p.m. and you already have an analysis placed, or probably you have trades placed as well, that can tell you that, oh, at 2:30 p.m. I need to be cautious of my trades, right? So if my trades are in profit, I need to put my stop loss into entry, or I need to close out some profits, or I need to just, observe what happens when this high impact news at 2:30 would be released, just so that I don't get stopped out of the market after being in a profitable trade. You don't want to do that as a trader, right? So the second thing you want to do is or the second step would be to focus on high impact events. Now, like I said, for beginner traders, you can include low impact, medium impact, just to get knowledge, but low impact events, they really don't move the market, as much as high impact events would, right? That's why you have NFP as a high impact event. I've not, since I started trading, I haven't seen a time where NFP has been a low impact economic event. It's always going to affect, it's always going to bring about volatility to the market. It can be low, it can be a certain amount of volatility this month, more volatility next month. It just depends, but it's a high impact event, and you should focus on that because that's going to bring about more volatility. Now, volatility is what gives traders money. It's the measure of price movement, right? If the markets don't move, traders will make money. So you look at high impact events, but as a starting, you can just look at the low impact events to understand what they mean, and the third step would be to confirm the release time and understand the meaning of the event and possible outcome. So now, this is where you have to utilize the OctaFX economic calendar, because if you look at this calendar, you're going to see a list of economic events, so many, right? And as a beginner trader, you may not understand what this means. So what do? You click on any one of them, right? So let's say, for example, we want to understand what's the GDP for Sweden means, and this is quarterly, quarter over quarter. That's why you have QOQ. Just click on it and then you read, the gross domestic product released by the SCB is a measure of the total value of goods and services. And there's also a link for you to understand what SCB means. GDP is considered as broad measure of Swedish economic activity and health. And you also have an additional information that tells you a high reading is seen as positive for the krona, which is the domestic currency for Sweden, while a falling trend is seen as negative or bearish. So now if you look at the report, this is a low impact event, by the way. But if you look at the report, you see that, okay, the previous was minus 0.9% and the actual is 0.6%. Now we know that this is positive, right? And what does it mean? So now you understand what GDP means generally. You understand who it's been released by in Sweden. You understand what a high reading and a low reading would mean. And now you can check the reports to see what reading it actually is. Okay. All right. The next one. Excuse me. So the next thing you want to do is to take note of the previous and forecast. So you want to take note of the previous and forecast. And, you know, I said it here where you have to look at the previous reports. The forecast is like a prediction, OctaFX prediction. And the actual is the actual result, you know, of the reports. For example, we have this medium impact event, the Japanese unemployment rates. And you can see that previous, which was last month, it was 2.8%. Has been forecasted to be 2.7%, which is less than 2.8. And, you know, when it's a low reading, it should be taken as positive or bullish for the JPY, right? It's unemployment rate. If unemployment reduces, that means people are getting jobs, right? And we had 2.6, which is, you know, significantly lower than 2.8, which was the reading in the last month. Now, you've seen that, okay, the previous was 2.8, unemployment rate was a bit higher than it is this month, and that should be taken as positive or bullish for the JPY. You have your bias already on the unemployment rates in Japan, right? So you just keep that to the side. It doesn't mean you should just use that to start buying JPY, because we're going to merge it with technical analysis. And the next thing would be to wait for the news release, right? So let's scroll down a bit. We're going to see, what time is it? Yeah. Okay, we're going to see that we have, so for these ones that you're seeing past, it means that the reports have been released already. And we have one coming up by 10 p.m. This is in Nigerian time, GMT +1. We have the fiscal balance for Mexico. And you can see that it's still coming up, right? So what you want to do for an economic event that hasn't been released yet is that you want to wait to see the actual figures. Now, most times you're going to get suggestions and opinions from different news outlets, you know, different media outlets as well. You can see that always happen during CPI reports. You can see that happen during NFP reports a lot of times, you know. But a comfortable way would be to be patient for the reports to be released, and then you can identify what area you're going to trade that particular currency. You don't want to always try to be ahead of the market. You want to flow with the market. Okay? You're a retail trader, remember. All right. And the last thing would be to combine your bias or your reports with technical analysis and strategies. And this is important because you want to identify the areas where supply and demand zones should be kicking in and take advantage of those levels. You want to identify zones where, you know, supply and demand levels or pressure would be kicking in, and you want to take advantage of those levels. That's why it's good to combine with technical analysis as well. So guys, if you've got questions, you can always ask your questions in the comments. We're going to have a section where I answer your questions, but just so that you don't forget, just type them in the comments or in the chat box. So now we're going to move to technical analysis, right? Which is a more, where it has to do with some calculations as well. And this basically has to do with, you know, analyzing the charts or trading the charts. You know, we're not looking at anything, news reports here. We're just looking at what's going on the charts, right? And technical analysis is the process of evaluating and predicting future price movement in currency pairs It can be commodities as well. It can be stocks. By analyzing historical market data such as price and volume, and it is based on the notion that the price of a currency is decided by the forces of the market, and that the past price movements of an asset can provide insights into the price movements of an asset in the future. So basically, we're looking at what has happened before, and we're going to use that, the data, to predict what could possibly happen in the future. That's what we mean by technical analysis, right? The zones and everything that I'm going to show you guys in a few minutes, that's what you want to use to identify what's going to happen or what could possibly happen in the future. Through the examination of market data and the spotting of recurring patterns and tendencies, the purpose of technical analysis is to locate potential trading opportunities. Technical analysts make use of this data, well, generally traders, in order to devise trading strategies which may include the determination of entry and exit points, the establishment of stop loss levels, and the management of risk. So it's important to keep in mind that technical analysis is not fail-safe, and the conditions of the markets are prone to fast shifts. That's why I always tell you guys that when you want to analyze the charts, you want to look at fundamentals. You want to look at the areas where, give me a second, guys. Can you guys still hear me? If you can hear me, let me know in the chat, please, guys. If you can hear me, just let me know in the chat. So you want to look at areas where, or times where economic events will be released or economic reports will be released, so that you don't get caught up in a very volatile market that is just moving wildly up and down. All right. Okay, you guys can hear me. Beautiful. So technical analysis is a well-liked technique that many traders in the Forex market employ to examine data and make wise trading decisions. It's commonly used in conjunction with fundamental analysis, right? It's been combined. Just see technical analysis as your left hand and see technical analysis and fundamental analysis as your right hand. And if you're trying to lift up, like a dumbbell or something heavy, using two hands to make it easy, right? So it's good that you just combine the both of them to increase your possibility of making well-informed trading decisions. All right, we're going to look at the first thing under technical analysis. But before that, remember I told you guys that I was going to give you a definition of, or a briefing on sentiment analysis. Okay, you can hear me. Okay, great. So sentiment analysis is just like the name goes, sentiment. It's used to gauge or measure how other traders feel, whether it's about the overall currency market or about a particular currency pair. It's like you're looking at, how many traders are going long on this currency pair, how many traders are going short, how many traders are buying, how many traders are selling, how many traders are mixed, looking at that to just give you additional information. But the mostly used are technical analysis and fundamental analysis. Now we're going to look at the first thing, because there are a lot of things that make up technical analysis. We have the trends, we have supply and demand, support and resistance, we have the key levels, we have chart patterns, candlestick patterns. We're going to take all that and we're going to start with the trends, right? So what is a trend? A trended market is one where price is generally moving in one direction, and trends are usually noted by higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. I'm going to give you guys the illustration, so not to worry. Now we have two types of trends, right? We have two types of trends. We have the uptrend and we have the downtrend. Now, imagine, going to the boutique, for those of you that like to buy clothes, that when you get to the boutique, there's a particular type of clothes you see that is just trending, and it's usually brought out in front, so you can just see that this outfit is trending, and you see that after a while the outfit stops trending and another one starts to trend, right? So when it's trending, what happens? It increases in value, and when it stops trending, what happens to the outfit? It kind of starts to reduce in value, right? Same thing with the Forex market. It trends up or down. So the market is about to go up. That means it's about to start trending in an upward direction. And when it starts to make consecutive higher highs and higher lows, then you can call that an uptrend. And when it starts to make consecutive lower highs and lower lows, which means that prices are starting to decline, you can call that a downtrend, right? So the uptrend is a bullish trend that consists of a series of higher highs and higher lows. Prices are moving up. You can be convinced of an uptrend if there is a clear support line connecting at least two lows and limiting the downside. A break below this line signals weakness or reversal. I think I'm going to give you guys an illustration of what we mean by the support line. You know, we're going to talk about support and resistance. So I'll give you guys like an illustration of, you know, how you can connect your uptrend. Remember, with trading, while you learn how to trade, I would say a more efficient way to understand what exactly you're learning is to take the theory, like what you're reading, and just apply to what you see on the charts, right? So you take your support line, connecting the lows for an uptrend. For a downtrend, you take your resistance line and connect the highs, limiting the upside. So the downtrend is a bearish trend that contains a series of lower lows and lower highs, and this signifies that prices are starting to move down. Each trend consists of movements in the direction of the trend, which are intermitted by counter trend moves called retracements or corrections. So you can also see people call them, or traders call them, pullbacks. A trend is expected to continue until a reversal takes place and the direction of the trend changes. So when you see a trending market, it's expected to continue until you start to see reversal patterns, which we're also going to discuss. So it's going to be an interesting session where we explain technical analysis in detail. So brace up, guys, and focus, because from here we're going to talk about some really important things that can guide you in making or creating beautiful strategies in the Forex market. So we have a name, or a nickname that we call an uptrend and a downtrend. So we can call an uptrend a bull market, and we can call a downtrend a bear market. And if you're familiar with how these animals attack, you would know that when a bull wants to attack, it uses its horn, you know, just use its horn and takes you from down and pushes you to the top, right? And a bear attacks from, you know, with its hands and just attacks from up to down. So that's what it signifies: bull, uptrend, bear, downtrend. So we're going to be using a lot of that: bull markets, bear markets, bearish, bullish, you know, so just kind of keep that in mind. Bull for buy, bear for sell. Bull up, bear down. Same thing goes with positive and negative, you know, positive bull, negative bear market. All right, during an uptrend, the price makes higher highs and higher lows, and during a downtrend, the price makes lower highs and lower lows, and they're generally called swing highs and swing lows. So if somebody says there are multiple swing highs and swing lows in this uptrend, they're referring to higher highs and higher lows, and you can still use swing highs and swing lows for downtrend, but then you wouldn't call them higher highs and higher lows anymore. You'd call them lower highs and lower lows. Okay, but don't worry, I'm going to show you guys an illustration. So I think, let me just all right, let me just see if I can do like a drawing for you guys to see what we have here. Okay, so remember, made up of swing highs and swing lows. For an uptrend, I don't think, let me make it a bit smooth. Okay, so for an uptrend, you're seeing consecutive swing highs that we can call higher highs, right? Higher highs, and then we have higher lows. Pardon my writing, guys. Trying to get the H. Okay. And another higher high. I'm going to show you guys what this looks like on a live chart anyway, but this is just like to give you guys an illustration, all right? And if you have higher high here, then we're going to have higher low here, another higher high, and another higher low. And that's because you're seeing that this low is higher than the previous low, and this low is higher than the previous low. So higher highs, this high is higher than the previous high. That's why it's called a higher high. And this one is also called a higher high as well. Why? Because it's higher than the previous high. You can see it's higher than this one, right? And remember, you're connecting your support line. When you hear support, you're looking at down. When you hear resistance, you're looking at above, right? I'm going to show you guys, you know, an illustration of what it looks like on the charts. Support is an area where buying pressure could kick in, and you can see that for an uptrend, you're connecting your support line across the bottom of swing lows, right? The higher lows. And remember, support is an area where buying pressure could kick in, and you can see that at these levels where market bounced off your support lines, you can see that what happened, buying pressure kicked in and the market started to push to the top side. What happened here? Buying pressure kicked in, market started to push to the top side. And that's why we have consecutive higher highs and higher lows, and that's why this is going to be called an uptrend. Now, a downtrend, on the other hand, is made up of consecutive lower lows and lower highs. So the same definition, it's called a lower high because this high is lower than this high. Can you see it? We have highs that are lower than the previous highs. We have lows that are lower than the previous lows. So we call this a downtrend. And for a downtrend, you're connecting above. I'm going to clean that. Doesn't look really straight. I'm going to try to make it straight. So you're connecting above with your resistance line. You're connecting above. You see that resistance is where selling pressure starts to kick in, and you see that whenever price got to your resistance line, what happened? Selling pressure started to kick in, and markets pulled to the downside. Selling pressure started to kick in here again, and market pulled to the downside. Selling pressure started to kick in here again, and what happened? Market starts to push to the downside. The trending market is expected to continue to trend until you start to see some reversal patterns, which I'm going to explain for you guys as we get to the chart pattern section. But this is just a quick, you know, illustration of what uptrend and downtrend looks like. So we're going to have a live session where we identify this chart patterns, or this trends rather, on the live charts. I believe that you guys understand, or you guys are already getting the grasp of trends and technical analysis. Let me know in the comment section if you're getting a grasp, or if you're understanding, you know, technical analysis in general. All right, we've talked about this. A downtrend, for a downtrend, the trend line is drawn along the falling swing highs, which helps to show you where future swings may form. For an uptrend, it's the opposite. It's drawn along the rising swing lows, the support line. For a downtrend, you have to watch out for price to reach previous highs but are not able to break through. You have to watch out for price to reach the previous highs but are not able to break through. This can give you that previous high may align with your trend line. Sometimes it may not align with your trend line, but this can give you an indication that the buyers are no longer buying and we could be setting up for a move to the downside. The same thing goes for an uptrend, but just the opposite. You have to watch out for price to reach previous lows but not able to break through. That can tell you that sellers are no longer selling and we could be bracing up for a move to the upside. You also have to look out for break in previous lows to confirm the downtrend, right? So for you to have a lower low, that means the current low must break below the previous low, which makes it a lower low. Same thing goes for the uptrend, but just the opposite. The current high must break above the previous high, and then you get a higher high. Okay, profit should be taken for a downtrend as price flush below previous lows. You can set your stop to be adjusted at the previous high. Now, sometimes, if you're a scalper, previous high may be way too much. But I'm going to show you guys how you can set your stop loss if you're trading on the lower time frames. Generally, trends are temporary, so even if they have a strong potential for making profits, never risk too much on any trade. We're going to look at risk management because we have a session for that where I'll brief you guys on risk management and how to manage your risk, and you're going to learn how to minimize your risk to like 1%, 2%, and maximize your profits way up to 6, 7, 8, 9% on a trade. All right, let's look at I like to call it the basis of technical analysis, candlesticks, right? Because this is the mostly used charting pattern in the Forex market. You know, when I mean charting, I'm talking about the bar charts, the line chart, and the candlestick chart pattern. So candlestick is mostly used, and a candlestick is a single bar which represents the price movement of a particular asset for a specific time period. The information it displays includes the open, high, low, and close for that time period. It's the chart pattern or the charting that gives you like precise definition of what has happened during a specific time in the market. The line charts can just, let me quickly show you guys that. So the line chart can show you something like this, right? Now, you just know that, oh, this is a downtrend, market is moving to the downside. But you have no clue exactly what happened in this area, right? You have no clue. Candlestick chart shows you that. And we're going to learn how you can read a candlestick right now. So remember, it includes the open, high, low, and close for that time period. Now, if you look at these candlesticks, we have two candlesticks. We have two candlesticks here. We have the bullish, obviously you can see it's green. We have the bearish, you can see it's red. Now, why is this bullish and why is this bearish? A candlestick is called bullish when it closes above the opening area. A candlestick is called bearish when it closes below the opening area. So you can see that bull up, bear down still applies to literally everything in the Forex market. Now, it's bullish because it closes above, right? And you can see that you have this lower shadow and upper shadow, which are sometimes called wicks, W-I-C-K or W-I-C-K-S. Now, you can see that this is an indication that at some point during the open and close of this candlestick, price got to this point and price got to this point. This also tells you that at some point during the open and close of this bearish candlestick, price came up to this point and pushed back down. That's why you're seeing the shadow. This is like a trace that can give you an idea of what happened. And it came lower here as well before coming to close at this point. Now, we're going to have like a graphical or an illustration on the live chart where you can see the candlestick open and close live, and you read it together with me. Okay, so if you didn't really grasp it right now or grab it, then just I'll show you guys, you know, on when I go to the live chart. But let's look at some typical candlestick patterns, and after that we can now start to talk about looking at the live chart to understand exactly how to read a candlestick. So typical candlestick patterns. Now, there are a lot of candlestick patterns in the Forex market, right? But these are typical because that lot of candlestick patterns fall under this three, right? We're going to have some with big or thick bodies. We're going to have some with longer wicks, and smaller bodies. We're going to have some that don't even have any body or have like just a small body. Okay, so Remember, the same way, it's always going to be bullish if it closes above the opening point. It's going to be bearish if it closes below the opening point. Okay? And this wicks can tell you that the price of, or this candlestick, at some point during the opening and the close of this candlestick, price was at this point, at these levels. And this shows you momentum in the market, because now you're seeing that the bulls literally took over this candlestick. Same goes here for the bears, right? But this, in this case, doesn't tell you, I mean, it's a candlestick, but it shows you that there was a rejection, right? Now, you can see that it closed bearish. And when you look at a candlestick, what you need to first identify is it a bullish or a bearish candlestick? How do you identify if it's a bullish or bearish? By understanding where it's closed. If it closed above, it's bullish. If it closes below, it's bearish, right? And this candlestick closed below. You can see it closed right here, and that's why it's a bearish candlestick. Now, this upper shadow just tells you that at some point, the candlestick opened here. Buyers took it to the top, couldn't sustain that momentum above this point. And what happened? The sellers took over, pushed it back down below the opening point, and came to close it here. So the candlestick has given you an idea or an indication that, oh, okay, there was a time where this candle was at this level, right? The price came to this level, but couldn't be sustained and pushed back down. The same thing goes for the bullish candlestick as well. You can see that it opened here. The bears or the sellers took it down to the downside, couldn't sustain, and what happened? Buyers took over, pushed it way up to close above. And we have, and this can give you an idea that, oh, this is a rejection candlesticks. The bears have been rejected and the bulls are taking over. And we have the Doji candlestick, DOJI, which is an indecision candlestick. So neither the bulls or the bears were able to take advantage of this candlestick. So let's look at some candlesticks types. But before we do that, let me just give you guys an illustration on the live chart. Honestly, it's 1 minute. Let's read candlesticks on the live chart right now. Remember, guys, if you've got questions, you can always ask your questions in the chat. I'm just checking to see if you guys have questions and would answer all of them in the Q&A section. We're just going to zoom in a little bit. So we're going to wait for the next candlestick to open. It's going to be in like 6 seconds. All right, next candlestick has opened right now. And we can see that it's bearish, right? So for this, my layout, you can see white is bullish, blue is bearish, right? So it's opened bearish. And why did it open bearish? Because when it opened, it started to push back down. But you're seeing that there's a tiny trace right here. You can see the market is telling us that this price or this candlestick was down at this point. You can see it happen here. It came down and now it has come back above, or it's currently at the opening point. And you can see that if it pushes above, then it's going to change to white. So let's see if it's going to be able to push above and change to white. But as long as it stays below, it's going to be a bearish candlestick because it's trading below the opening point. But if it manages to push above, then it's just going to change to white, and that's going to mean that the buyers has taken over. Now, it wasn't able to push above, but you can see that this candlestick has given you an indication that the buyers pushed it way up. The sellers could not sustain below this point. The buyers took over and closed at the exact same point the price opened at. So if the buyers are able to push this above, it's going to change to white. You see, that's changed to white. Now the market is trading above the opening point. That's why it's currently a bullish candlestick. And as it's not there anymore, you're seeing the shadow is being created. And you can see that it's quite a struggle. You know, the buyers and the sellers are just struggling. And what does it form? It's forming a doji candlestick. Can you see that? It's forming a doji candlestick. This one is also a doji candlestick as well. And if it closes or ends like this, you know, that cross sign like this right now, it's going to be a doji candlestick. But let's see how it plays out. Okay, so you can see that it closed bullish because it closed above the opening point. So that's basically how you can read a candlestick. Now you can always come back to this video. It's going to be saved here. So you can always come back to this video to, you know, learn and relearn and understand exactly how to read a candlestick. So we have various types of candlesticks. We have the engulfing candlestick, and the engulfing candlestick goes for the bullish and bearish candle, right? So the engulfing candlestick signifies a reversal of the current trend in the market. Now we have, remember, market moving in a specific direction is a trending market, but there's just so long it can move in that direction for it's always going to come back. Whatever goes up must come down. The market cannot just trend up forever, right? There could be retracements, there could be a total reversal. So engulfing candlestick signifies a reversal of the current trend in the market. This specific pattern involves two candlesticks with the latter candle engulfing the entire body of the candle before it. The engulfing candle can be bullish or bearish depending on where it forms in relation to the existing trend. So you can see right now that we have a candle. So this called this when we say the latter candle, the one before the engulfing candle. So this is the latter candle, right? Now we can see that this candlestick closed bearish because it closed below, and now you see the bullish engulfing candlestick that just kind of swallows the entire candle before it. You see that the closing and opening point has covered. So if you're standing somewhere around here, so let's say okay, let's just use this one. So let's say you're standing here, right? Because this candlestick has engulfed the previous one, you'll be limited to this information. So you won't be able to see this previous candlestick here, right? It has engulfed it, it has covered it. And remember, I told you guys that this type of candlestick signifies momentum. Okay, this kind of candlestick signifies momentum. And when you see engulfing candlesticks like this that occur at the bottom or the top of a trend, then you're looking to a market that is going to reverse. So if it's an uptrend and you see an engulfing candlestick, a bearish engulfing candlestick start to brace up, like you can see here, it's moving to the top. You're seeing the bearish engulfing form, and what happens? Market starts to push to the downside. For the bullish, you can see the bearish engulfing candlestick form, and what happens? Market starts to push up. Now, if a bullish engulfing candlestick occurs in an uptrend, then that's going to signify extra momentum that the market is going to push further to the top. And the second candlestick we have is the evening and the morning star. The evening and the morning star candlestick patterns are also reversal patterns, and they occur at the end of an upward or downward trend respectively, and they tend to indicate reversal patterns, right? So you can see the evening star here, and you can see the morning star here, right? So you can see that this just tells you that the market has, you can see the bullish, you can see the rejection here from this shadow, and the next candlestick is a bearish candlestick. You're looking for the market, and you're looking for a scenario where the market starts to drop. This occurs at the top of an uptrend, and this occurs at the bottom of a downtrend. So you can see here the market is coming from a downtrend. You can see the rejection, you can see the follow-up bullish. What's going to happen? Market is going to start to push to the upside. But there are confirmations that you should look out for when these patterns form, and we'll also discuss that when we get to the practical session. So you see the illustration of the evening and morning star on a live chart. You can see how the market started to reverse to the downside. And we have the Doji candlestick, which is an indecision candlestick. I told you guys, neither when you have Doji candlesticks form, it just tells you that neither the bulls or the bears were able to take advantage of that particular candle. Okay, so it was a struggle. We saw it happen in the when we looked at the live chart. We saw the struggle, how it was just happening, and it eventually closed at the same opening point. Now we have some types of Doji candlestick patterns, right? We have the Doji star, which is like this, cross-shaped, same opening and closing price, small or equal length of the upper and lower wick, and it indicates indecision. We have the long-legged Doji, extended upper wick and lower wick, greater volatility, and what does it signify? Indecision. We have the dragonfly Doji. I think you guys saw this on the live chart, right? You saw the dragonfly Doji, and if you remember what happened, I think I'm just gonna go back. You can see the dragonfly Doji form here from this downtrend, and what happened? The market started to push to the top side. Can you see it? After the dragonfly Doji formed, we had two Doji candlesticks again, indecision, and boom, reversal. Another breakout again, reversal to the top side. So what does the dragonfly Doji signify? You can see here, change in direction, shows the rejection of lower prices and gives you a bullish signal. We just did this right now on a live chart and you can see it happen. The gravestone Doji is the opposite of the dragonfly Doji. You can see that it shows the rejection of higher prices and it also signifies change in direction. The four price Doji doesn't have any shadows or any wicks. The high, low, open and close are all at the same level, and it's a unique pattern that signifies indecision and illiquidity or low volatility, right? And it signifies or indicates ultimate indecision. So these are the types of Doji candlesticks that we have in the Forex market. And even as Doji candlestick signifies indecision, you can see gravestone and dragonfly Doji that tells you, okay, this can be a change in direction and you should look out for it. Now we're going to look at hammer candlestick, and a hammer is a bullish chart candlestick, and it tells you that the bears have been rejected, right? So you can see the hammer has the head of the hammer and the handle, right? Looking like Thor's hammer. I know you guys watch movies. So you're familiar with how Thor's hammer looks like. And you can see that even as this one closes as a bullish and this one closes as a bearish, it's still a hammer candlestick. And it still signifies bullish reversal. Why? Because it tells you that prices were rejected from the downside. You can see it opened here, pushed down, but the bears, the bulls took over and closed it. So even if you closed below the opening point, it just tells you, look, the buyers has a longer portion of this candlestick than the sellers, right? Same thing goes for the bullish candlestick as well. This is bullish because it opened, pushed up, it opened here, pushed up, came down, pushed up again and closed above the opening point, right? So I hope you guys are familiar with how to read candlesticks right now. Now, you can see an illustration of the live chart. You can see it right here on how a hammer forms at the bottom of a downtrend and it indicates bullish reversal. So you can see the hammer is being formed and price started to push to the top side. Now we have a shooting star, which is quite the opposite of a hammer pattern, right? So you can see that the shooting star is just hammer turned upside down because it shows you rejection in higher prices. So when the prices have stopped from pushing higher and the sellers have, taking over, they're pushing the prices to the downside, the market forms this pattern that is called a shooting star pattern. Sometimes you can see a smaller wick down here and a longer wick at the top, right? Let me just give you guys like an illustration of how it looks like on the chart. So you can see that there's a smaller wick, but you can see that the sellers have a high or a huge portion of these candlesticks, and it has occurred at the top of an uptrend. And what happened next? Bearish candlestick, indecision candlestick that still closed bearish, and you have the breakout to the downside. So you see, reversal patterns occur in the market. The market is not always going to just trade and trend to the top side. You can take this illustration and just apply it to your analysis. We're going to do that as well so you can understand better. But let's look at support and resistance, which is also an important aspect of trading. So what is support and resistance? Support is a level where demand is thought to be strong enough to pause the price from declining. As the price of an asset drops and gets cheaper, buyers will tend to buy more, as sellers will be less inclined to sell, thus forming a support line or a support level. Resistance level is a level that will often be strong enough to pause the price from rising. As the price of an asset moves towards resistance, sellers will tend to sell more and buyers will be less inclined to buy. So it's just like saying you want to buy a shoe and the shoe costs like let's say $600, and the price of that shoe increases the next week to $650, and the week after that it increased to $700, and the following week it dropped from $700 to $600, right? Now if you're someone that deals in shoes, you've observed this shoe market, and you've seen that, oh, it got to 700 and the price dropped drastically to 600, right? So when it starts increasing again, okay, it's from that same 600 increased to 620, 650, 670, and it gets to 700. You already, I mean, in previous times, what happened when it got to 700? It dropped, right? So your mind is going to tell you, okay, start selling right now because the last time it was here, the price dropped, right? So just because you want to make profit and you don't want to just get caught in a shoe or a market that has lost value, then you start to sell, right? So you can close out your profit. That's how it happens in the Forex market as well, with support and resistance. The easiest way to find support and resistance is to use swing highs and swing lows, which we've discussed, and you just connect your trend lines in a trending market. You can also use support and resistance when you're looking at key levels, right? We're going to do all that when we get to the practical session. So you can see in this illustration, you can see that this is like a market that's trending to the top side, but even as it's trending to the top side, you can connect your support line across the bottom of this, across the higher lows, rather. Let me just use higher lows so that you guys can get familiar with that. And you can also connect a resistance level here that the price failed to break above in the past and finally broke above later in the future. And what happens when price breaks above a certain level? If it's resistance, that resistance level becomes new support for the market. If it's support, that support level becomes new resistance for the market. So here's what it looks like, right? On a live chart. So we can see the market has been resisted from breaking above this point. You can see here as well. You can see support levels formed here, resistance level from here. The market finally broke above, and when the market moves like this, there's always going to be a breakout to either side. It could be the top or the bottom side, but when the market consolidates like this, a breakout is coming. And it finally broke above, and what happened? This resistance level became new support for this market, and we saw the rejection, we saw the bullish momentum candlestick, and the market started to push to the top side. See? So how do you trade support and resistance? First, you need to know your trading preference. What's your trading preference? What's your risk tolerance like? Because there are two ways to trade support and resistance. Are you a scalper? Are you a long-term trader? That can help you identify the areas where you should look for support and resistance. Because if you're a scalper and you're going to trade support and resistance on a 4-hour time frame, then that's going to take you a lot of time for your financial results to be achieved, right? So you know your trading preference. That can help you identify areas where you should draw your support and resistance lines. And the ways you can trade support and resistance, you can trade the bounce or you can trade the break. Now, when you trade the bounce, you're trading whenever price gets to any of these levels. You're going to buy. If it gets here, you buy. If it gets here, you sell. So you're just trading the bounce. That's one way you can trade support and resistance level. And you can also trade the break, like the breakout, right? And there are two methods to trade the breakout. The first method, you buy or sell when price breaks out through a specific zone, can be resistance or support level, but you're going to run a large risk of entering false breakouts by simply entering immediately the price breaks out, right? So that leads us to the second method, which is instead of entering just as the price breaks out, you can be patient enough for the price to pull back a little bit or retest the support or resistance level, and you enter after the price bounces. So here's what I'm talking about, right? So we have this resistance level here, obviously. See the rejection. The price got to this point, rejected, and you see this momentum candlestick, right? So if you're a type of trader that likes to just trade whenever the price breaks out and you just buy here, what happens? You're going to get stopped out of the market, right? But if you are patient enough for the market to break out and pull back, retest, you're seeing the indecision candlestick, you're seeing that the bears have been rejected from breaking below this previous resistance that has now turned support. Now you're more comfortable to place a buy here, and you have a large room to take out profits. So these are two ways you can trade. Like I said, the trading preference is an important factor in deciding how exactly you want to trade support and resistance. Now we're going to look at chart patterns, which is also an important aspect of trading. Chart patterns is basically like a way that you can get familiar with what has happened before in the market and use that to identify what could possibly happen in the future. So it's a graphical presentation of price movement where you use a series of trend lines and curves to identify what's going on in the Forex market. Now we have two types of chart patterns. We have the continuation chart patterns and we have the reversal chart patterns. And the continuation chart patterns help traders to identify opportunities to continue with the trend. And we have common continuation chart patterns like the triangle pattern, the flag, the pennant patterns. We also have reversal chart patterns, which is the opposite of continuation chart patterns, where traders utilize these reversal patterns to look for where trends have ended and could potentially reverse to the downside. We're going to look at some examples, like the flag chart pattern, which is an example of a continuation chart pattern. You can see it right here. The flag pattern occurs when a sharply trending price, you can see how it's trending sharply to the downside, suddenly pauses and retraces slightly in a rectangular range, and it then breaks that range and continues in the original direction. This is the original direction to the downside. Retracement, breaks, and continues to the original direction, giving you the opportunity to enter the second half of a trend at a better price than even before the flag formed. So you can see right here, you have that breakout, the slight pullback. So if I'm going to place a trade here, I'm going to be entering here, somewhere around here, because now I have room for my stop loss and I have more confidence that, oh, after this breakout, then I'm seeing more momentum. I have more room to the downside to take out my profits. Same thing goes for the bullish flag pattern. Sharply trending to the top side, retrace, breakout. In this case, we didn't get any retracement, so you can look for entries at halfway into the next bullish candlestick and take out your profit there as well. Or if you find consolidations like this, you can also add more entries at the breakout of that consolidation. But this is for continuation chart pattern. So when this chart pattern forms, you're looking at the markets, moving more into its original direction. And we have triangle chart patterns as well, which are symmetrical, which can be symmetrical, ascending or descending. Now, a symmetrical chart pattern is a chart formation where the slope of the price highs and the slope of the price lows converge together to a point where it looks like a triangle. An ascending triangle is a type of triangle pattern that occurs when there is a resistance level. You can see the resistance level up here and a slope of the higher lows. You're seeing that your support line is being connected along the higher lows, along the bottom here. As you can see, it's right here. And this forms an ascending triangle. Remember, this is a continuation chart pattern. We also have the descending triangle chart pattern where there is a string of lower highs, you can see here, that forms the resistance line, and there is a lower line called the support level. And once price breaks the support level, we're looking for opportunities to go further to the downside. Now, there are some ways that you can trade chart patterns. That's why we are going to look at these chart patterns or this triangle patterns keynote. You want to always take note of the direction of the trend prior to the consolidation period. What is the original trend? What is the initial trend? Is it coming from an uptrend or a downtrend? Okay, triangle pattern has formed. Are we going to continue to an uptrend or are we trying to reverse? You want to take note of that Since it's a continuation chart pattern, they're looking for a continuation to either the top or the downside, depending on where it started coming from. You also want to make use of upper and lower trend lines, like I've discussed in the support trend lines, the resistance trend lines, to help you identify which triangle pattern is being formed. You want to use the length from the flag poles to forecast appropriate target levels. You want to use the length from this flag poles here to here to identify your target levels from your entry to the top side. And you want to adhere to proper risk management to reduce the risk of a false breakout and ensure a positive risk to reward ratio is maintained on all trades. You could see a continuation chart pattern, and then you see price not even continue to the original direction. That's why you should wait for confirmation and also use proper risk management. Now we're going to look at double top, which is a type of reversal chart pattern. It's very popular. And a double top is a chart pattern where the price reaches a high twice and fails to break out higher during the second attempt. We have the first top here at the resistance, failed to break out the second time, and what happened? The market started to push to the downside. You can see it right here. And we're going to draw the trend line or the support line, which is going to be our neckline, to tell us that, okay, once price breaks below this point, we're looking at a retest and a push further down, right? So we have the double top. This is how it looks like on a chart. You can see that it's very smooth here, but when you come to the chart, you can see that it's quite noisy, and that's why you should always practice, so you don't expect the market to just move boom down, boom down. No, it's not always going to move like that. Okay, so you want to take the measurements from the resistance to the neckline to identify your target levels from your entry point. And if you just use, for example, this shows 270 pips, you can use that to say, okay, I'm going for 270 pips. I can close out some profits here using the swing low and just let the rest of the trades ride for 270 pips. That can help you identify your target levels on different chart patterns. We have the double top, and we also have the double bottom, which is opposite of the double top. Now, the double top occurs at the top of an uptrend and shows reversal to the downside. Double bottom occurs at the bottom of a downtrend and shows reversal to the upside. You can see it here. Rejected from going to the downside, first bottom. Second bottom rejected as well. And what happened? Price broke out from the neckline, made a retest, rejected 3 times. And what happened? Price started to push to the top side. So it's quite the same with the double top, only that this is not a reversal to the downside, but a reversal to the upside. So now we've looked at 2 types of continuation chart patterns and also 2 types of reversal chart patterns, the commonly formed ones in the market. We're going to now talk about indicators and what they are and how you can use them in your trading. Okay, so indicators are mostly used to forecast price changes in the Forex market. They are calculations which take the volume and price of a certain financial instrument into account. Technical indicators can help you identify possible entry and exit points for trades. Now, just to help you understand what indicators are like, you can think of indicators like your traffic lights, right? So let's say you're driving or you're in a car and you're going to a certain direction. The traffic lights are just indicators that will tell you this is when to go, this is when to stop, this is when to get ready, but you already know where you're going to, right? So if the market is trying to trend to the top side, you can use your indicators as a confluence, like as an added factor to determine where this price is going to go to. And it's important that while you trade indicators, you don't just depend on indicators to give you your entry and exit points. You use market conditions, the structure of the market, like your support and resistance, the trends, and then your indicators can just be like an added factor or an added determinant for your trade decision. And the first indicator we'll look at is also a popular one. It's called the moving average. The moving average is simply a way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. Moving averages are one most used technical indicators and they don't predict price direction. Instead, they define the current direction with a lag. So let me show you what the moving average looks like in an actual chart. Take this to 4 hours. Okay, let me just take off all the drawings. So you can see that this is a 200 period moving average. I've taken off the main chart itself, but you can see that the moving average just tells you that it just sums up, gives you like an average direction of the market. So you know that the market was like this, it moved like this, was in an uptrend for a bit and started to reverse. So if I put the chart back, you see that that's what happened. Moved like this, was in an uptrend and started to reverse to the downside. So they don't tell you where it's going to go to, they just do like an average and sum up and smoothing out all the noise for you to identify, you know, direction of the market. And there's some ways you can trade the moving average. You can trade the moving average by trading the moving average bounce, which is, you know, trading whenever the market or the price bounces at the moving average. You know, you can see how many times it bounced off, bounced off, bounced off, bounced off, and what happened. Started to move to the top side. Let's see if you can look for that on the chart. So you can see somewhere like here. Let's go to the lower time frames. All right, so you can see that for the most time during this, well, from 15th March 2023 to 4th May, you can see that the price always pushed up whenever it bounced off at the 200 period moving average. You can see it here, right? So you can identify areas where buyers could just step in whenever the market starts to push back down to this moving average, and you get the indication that okay, buyers are going to start pushing in from here and push this price up. You can see it happen a lot of times here. Excuse me, guys. So we have the bounce. For the moving average, you can trade the bounce. You can also trade the moving average cross, which is where you can use the 50 and the 200 period moving average. You can use the 100 and the 200 period moving average. We're looking at a scenario where the 100 period moving average crosses over the 200 period moving average, or the 50 period moving average crosses over the 200 period moving average, and that can give you an indication that, or if it crosses above, then the prices are starting to push to the top side. If it crosses over below, then prices are starting to push to the downside. But remember, it's the smaller period moving average crossing over the larger one. Okay. Now we also have another indicator that is called the relative strength index. It's called the RSI. Give me a second, guys. Yeah. So the relative strength index was popularly or is a popular indicator in the forex market that was developed by John Willis Wilder. He's a technical analyst, and he has this book on technical trading systems that actually gives an in-depth understanding on indicators as a whole, you know, the parabolic SAR as well. And the RSI helps traders in identifying overbought and oversold levels or conditions in the Forex market. A movement of 70 or higher indicates overbought conditions and an increase in the possibility of price weakening or going down. Price movements of 30 or lower indicates oversold market conditions. Some traders like to use 80 and 20, right? But you can use 70 and 30. So let me give you guys an illustration of what it looks like. So you can see that this is like an example of a live chart. We'll still go over to a live chart and see what it looks like. So you can see that we have these two lines. We have 70 here, we have 30 here. And we can see that whenever the market cuts above 70, which is overbought levels, what happened? The price started to push down, right? So just remember the illustration I gave you guys about buying a shoe and it gets to $700 and the price has to come down. So imagine that the price moves from 700 and it enters like 750 and 800. A lot of people are going to get scared that, oh, this has gone too high, let's start selling. Something like that, you know, and the price starts to drop down. We have overbought and oversold levels in the Forex market for relative strength index. Let me just go over to the live chart to show you guys. All right, I think I already had that. Let me just take this one off. Okay, so you can see that you can see 70 up here, 30 down here, and you can see whenever the price got to, I mean, this is, look to the right, look to this area, you can see that this is like 82. That's above overbought levels. And if you look at the chart, what happened? The price started to drop down. If you look here as well, 75. Look at the chart, what happened? Price started to drop down. If you look here as well, 76. That's above 70, above overbought levels. And what happened on the main chart? The price started to drop down. Look here, 75. Look at the main chart here. What happened? Price started to drop down. You look here as well, 72.72. Look at the main chart. What happened? Price started to drop down. So, like I said, you're not going to trade indicators just in isolation, but because, I mean, if you look at all these drops to the downside, you see that there were just a few pips. Just a few pips. This was actually the drop that pushed the market to the downside. And just like an easy analysis, let's just do a quick one right now. So you see that at this point, price was at overbought level 72 here. So what you can just basically do is, remember, it's a confluence thing. A lot of things has to happen for you to be more confident about your trades, right? So now you have this resistance already, right? Market is overbought. You have resistance. Market has failed to break above that resistance. What else are you looking at? Your 200 period moving average. Market has gotten to the 200 period moving average, broke below it, and now you're seeing a retest at that 200 period moving average, and the price has failed to break above. Now you have your overbought level, you have your resistance, you have your 200 period moving average, you have the break below the 200 period moving average, you have the retest, and the final thing you're going to have is the break below. Let me just put it here. You break below the support level, you have that nice break and another retest at the resistance. There you have your indication to go short. Okay, so you see that a lot of things were, you just quickly did like a basic analysis, and you see a lot of things were put in place. We didn't just look at the RSI oversold or the overbought level and started to sell. We used a lot of things to identify these areas. We used the 200 period moving average, we use support and resistance, we use the break and the retest of the 200 period moving average, we use the breakout of the support, and price started to push to the downside. All right. So that's basically how you do it, and from there you can start increasing your knowledge to identify, areas where, smooth areas where you can just get, sniper entries from the market. So let's look at how to apply risk management to your trading. We've talked about a lot of fundamentals and technicals. Now, how do you apply risk management to your trading? Best way to do that is to understand what risk management actually is. So risk management involves identifying, accepting, and mitigating trading decision uncertainty. Risk management plays an important role in your trading journey as a beginner trader, since Forex trading entails taking considerable financial risks. With a proper risk management strategy, you can reduce the chances of blowing up your trading account. So you're not always going to be certain in the market, but when you have a proper risk management strategy, then you can be more confident and comfortable to place trades, and you stay in the market long enough to even place more trades. Okay, so why should you use proper risk management? Forex risk management enables you to implement actions to ensure any negative impact of a trade is manageable. Now, if you have an effective risk management strategy, which we're going to discuss as we go further, you can add that to your trading strategy, and that's going to improve how well you can enter and exit a market. And it's important that you actually include your risk management strategy and you actually decide on how much you want to risk on a trade before you start trading. The proper risk management is going to minimize your losses and keep you longer in the market to place more trades. There's a saying, the market rewards those who are long enough to place more trades in the market. So let's look at how you can calculate or choose your risk to reward ratio. And it's a simple percentage calculation, right? So first, you want to understand market conditions that can help you identify areas where you're going to put your stop loss. And then when you identify areas where you want to put your stop loss, you have to use a position size that would align with a certain amount of risk. So if I want to risk, let's say I want to risk $20 on, or I want to risk $10 on a $1,000 account, $1,000, I want to risk $10. That's going to be 1% risk, right? Here's how to calculate it. 1,000 divided by 100 multiplied by 1. You get 10. 1,000 divided by 100 multiplied by 2. That's just a percentage calculation for 1% and 2%. The same thing goes for 1% and 3%, right? Now, because I want to risk $10 on a trade, I'm going to use, and let's say I want to risk $10 and my stop loss is going to be set to like 20 pips, for example. I'm going to use a lot size that can keep me within $10 risk and also within $20, within 20 pips stop loss. You can let me know what lot size that would be. You want to risk $10 and you're using a 20 pip stop loss. So what lot size would you use to make sure that you're risking $10 and you're not exceeding 20 pip stop loss? Let me know in the comments if you know the answer to that. Let me know in the comments. So you're going to be using a micro lot size, 0.05, because every 10 pips and the 0.05 lot size gives you, is worth or is valued at $5, right? And 20 pips is going to be valued at $10. So you're going to be using a 0.05 lot size. So I just wanted to quickly answer that, but if you didn't know the answer, you know now. And you can always use the OctaFX profit calculator if you want to calculate how much you are going to make on a trade or how much you want to risk on a trade. The calculator is right here. So you come to analysis and education and come down to profit calculator, and you can take advantage of that. You can see it here. All right, so let me give you guys an example of, an example why you should use a proper or a moderate risk to reward ratio. So let's say you want to risk 1% of your account balance, right? And Ambrose has $1,000 in his account, a trading account. The profit rate after 8 trades is 50%, and the risk to reward is 1:2, ratio 3, ratio 4, and ratio 2. So that's 4 trades, 8 trades total. 1 to 2, 1 to 3, 1 to 4, and 1 to 2 again. Ambrose risks $10 on a trade, which is 1%. Remember, profit rate after 8 trades is 50%. So we're looking at 4 profitable trades and 4 non-profitable trades. So result after 8 trades, first 4 were non-profitable, the last 4 were profitable. Now, because I only risked 1% of my trading account, then I'm risking $10 on a trade. Is defined $10 on the first trade, $10 second trade, $10 third trade, and $10 fourth trade. Now this is $40 out, and I still have $960 to place more trades. So the remaining 4 trades are profitable. I made $20, $30, $40, and $20. And now we're going to add 60, 90, 110 to 960. And you can see 60, 90, yeah. And you can see that the balance is currently $1,070. So this just goes to show you that at the end of the day, you need to define your risk, because that's what you can control in the market. You can increase your profits target to 5%, 6%, depending on market conditions and your preference. But what you should be very particular about is your risk, because that is what you can control. So let's look at how you can create your trading plan. And this is very essential for beginner traders, because for you to actually stick to a certain strategy and have a certain approach to the market, you need to have a plan. There's a saying that goes, if you fail to plan, you plan to fail. So a trading plan is a comprehensive decision-making tool for your trading activity. It's going to help you decide what, when, and how much to trade. Your trading plan should be your own personal plan. I mean, you could use you could follow these steps that are here, but remember that your capital is not going to be the same as everyone else's, and your risk tolerance is not going to be the same as everyone else's as well. So you can use someone else's plan as an outline, but create a trading plan to fit into your personality, your schedule, your risk tolerance, your available capital. So here are some steps that you can follow when you're creating a successful trading plan. First, you have to outline your motivation. Why do you want to trade? Family, financial freedom, whatever it is, you have to outline it, because it's going to give you the jump starts you need. Secondly, you have to define your goals. What do you want to achieve from trading? You have to define them. You have to be precise about them. It's good to write, like, maybe let's say, I don't know, you can write your goals. I'm not going to tell you how many goals you're going to write. You know your goals, so write your goals. But yeah, the third thing to do is to assess your knowledge of the Forex market. How well do you know the market? And be true to yourself. You know, you have to be true to yourself. How well do you know the market? If you don't know so well, you can always learn. It's a market that is evolving. I learn new things every day about the market. You know, it can be small, it can be just 0.5% knowledge, but I just learn. You know, it's a market that evolves. Sometimes you can trade a pandemic market. Sometimes you can trade an election market. There are things you learn from the market. You should just create that vacuum to learn new things from the Forex market. And the fourth thing you want to do is to check your trading style. Are you a day trader? Are you a swing trader? This can also help you identify when you should come into the market. Because if you're a scalper, you're always going to have to be on standby to close your trades. But if you're a swing trader, you can use that to identify times that you want to analyze and times you want to trade. Decide how much time you want to commit to trading. For beginners, this also has to do with times you want to learn. And the more time you spend to learn something, the faster you learn it and the better you get at it, right? You have to decide how much time you want to commit to trading. If you decide that you want to commit 30 minutes every day, you're not going to have the same results as somebody that commits 2-4 hours every day. Decide how much capital you want to start with, or you choose to start with. And this is dynamic for everybody, right? Not everybody earns the same or makes the same income. Not everybody has the same available capital or risk tolerance. So you look inward and identify how much you want to start trading with, You decide yourself. Choose a moderate risk to reward ratio. So I know that I told you guys that, oh, you can risk 1% and make 5-6% depending on market conditions, but you have to be realistic about it. You're not going to start looking for 1% risk and 50% reward. If the market tells you, if you look at your analysis and that's what the market shows you, fine, but just be realistic. And also, you don't have to start risking 5% to make 2%. That's not an ideal and healthy way to trade. And the last thing you want to do is to choose what pairs to start trading on. As a beginner trader, you don't want to start trading all the pairs. I mean, we have a lot of pairs. You can trade multiple pairs with OctaFX. You can trade currencies, you can trade digital currencies, stocks, you can trade indices as well. But as a beginner trader, you have to start with a specific amount. You can start with major pairs like pound dollar, euro dollar, Kiwi dollar, Aussie dollar. Start with those pairs, and as you get better at them, you can start switching to trading commodities, indices, digital currencies, and all that. Okay, so start with a few, and then you can start diversifying to the others. All right, so let's do a quick practical session. And put everything that we've learned together. So let's see if we can do like an analysis, a quick one. If you have currency pairs you want me to analyze, you can let me know before we do it, so that I can be sure that I'm getting to you and you're resonating with my analysis. So let me know in the comments. Also, if you've got questions, we're about to go to the Q&A session, so also let me know in the comments as well. All right, so let's say you want to start analyzing, and this is we're doing like kind of like a back test, and this one is on pound yen, GBP, JPY, right? Now, the first thing you want to do is identify your key levels, your zones. You want to basically identify areas where you can buy and areas where you can sell, right? So we're going to do that by using the tools available. We'll start with this level, which is going to be our support level, because you can see that price faced a decline whenever the market got to this point, right? And we're also going to have that added here as well, because price faced a decline whenever it got to this point. I'm going to extend that a little bit. And remember, guys, this is like a back testing, so I'm also going to add one here as well, because we can see that price faced a decline here, faced a decline here as well. So that's like a minor key level. That's why you have it on dashed or dotted lines. So let's see how it goes. So as the market moves, I'm going to be adding, looking for opportunities just to show you guys how to analyze the market. Okay, so I'm going to have to add a trend line here, because obviously we're seeing that there has been multiple rejections. Let's change that to black so you can see it. Yeah. So I'm going to have to add a trend line here, because what's going on? Okay. As you can see that whenever the price got to this point, we had, you know, a push to the top side, right? You see the rejection, buying pressure kicked in. We had that nice push to the top side. So let's see how we go. You see another one has happened. We're seeing another push to the top side again. And this can be levels where you can just bank on and take buy trades, put your stop loss at this previous swing low, which is going to be this swing right here, somewhere around here, and back on and just make some profit. This is about 350 pips with like an 89 pips stops, and that's like a 1-to-4 risk to reward ratio. And if you notice, whenever the price got to this resistance level, you started to see some rejections, right? So you can see that price has maintained this resistance level, and if it gets to break above it and we see a retest, then we can also bank on that as well. So we're seeing a consolidation. So what we can do here would be yep, we had a nice break to the top side. We had a nice break to the top side. We had the retest, another opportunity to bank on as well. You can see it right there. Another opportunity to bank on. And you can see that your targets, you can use the previous areas where markets made some rejections. You can see it right here. The market just came to make a retest at this area, this level where it already consolidated previously in the past. It's going to set this properly. Yeah. So consolidation, breakout, you see the retest on the previous resistance that has turned support, and what happened, price started to push to the top side. You can take out your profits, and this is basically how you can analyze charts, trade, and make a profit for yourself. So we're doing like a simple price action analysis. So basically, we can still choose to look for buy opportunities if we get a retest, because this is still valid. It's still valid because we have not broken below it, right? The trend line is still valid. We've not broken below the trend line, so we can start to look for buy opportunities. Boom, guys, you can see that already. We have the break below the trend line. We have the retest at this previous minor key level. This can be your indication to go long. You can also go to the lower time frames. You see these rejections can also give you some meaningful indication candlesticks on the lower time frames. There's something that we call the weak fill strategy, where when the market tends to create wicks or shadows like this, there's going to be a retest to grab the orders there and push to the top side. So what you can expect would be maybe from this previous resistance level, you get to see some pushback down to this level, grab the orders, you can take your buy trades and push to the top side. So you guys can see that this was a good opportunity for us to actually hop on a buy trade. I'm just going to do it. Let's see. Put our stop loss right below. And we can even take targets at this level right here. Yeah. And remember, guys, this is on the 4-hour time frame. So if you're on the lower time frame, you can just go to the lower time frames and identify entries on there. Let's see if you can do that. Okay. Let's see if you can identify entries on the lower time frames as well. So remember, guys, this is still valid. The minor key level is still valid. This is the previous trend line from the 4-hour time frame. And if you look at the bounce, whenever it bounced off at the moving average, what happened? It started to move to the top side. If it breaks below the moving average, then you're looking for a retest. You can see it has broken below. So we're looking for the market to push further down, maybe push back up a bit, like it has just done now. And then we find our sell entries and we just rally the market to the downside. You can see. Boom. Retest at the moving average. We're expecting the market to drop down a bit. Put our stop loss around here. Boom. That would have been your take profit because you have the bounce, your stop loss at the previous swing high, your take profit at the resistance line, or you can just put the take profit somewhere around here. You can have multiple take profits for multiple entries. So you can take out the first profit here. You can look to take out the second profit maybe at these levels. So if you're on this trade, you would have taken out your first profit, and for the remaining trades, you can set your stop loss into profits and have a risk-free trade. So you can see that at this point, the trade would have been profitable, all profits would have been hit, and you'd have made some money from this trade. Guys, it's important to understand that this candlestick didn't just happen in once. I know that we're doing like a back testing right now, but you have to be patient enough for your market, or for the market to play out in your favor. You don't want to, this candlestick is on the 15 minutes candlestick. That means that every single candlestick here formed in 15 minutes. So you've got to be patient. Okay, it's every skill that every trader must master. So let me know in the comments if you understood this analysis. You can always remember, you can always watch this video to understand how we utilize the support and resistance levels and how we're able to grab the opportunities that we grab from the market. And you can constantly practice and apply it to your trading. You can create a demo account with OctaFX. The link is in the description. Create a trading account, a demo account to practice, and when you're confident, you move to a live account and you start making real money. Now, I'm going to wrap up the session with diversifying your investment portfolio, and this is for traders that would want to utilize other instruments to make or create more sources of income, right? What are the steps to diversify your investment portfolio? First, you need to understand your investment goals. What are your investment goals? What do you want to achieve from investing? Because now you're not just trading, but you're investing. When you start diversifying, you're investing. Secondly, you need to assess your risk tolerance. What's your risk appetite like? How is it? You need to understand the alternative market. So by alternative markets, obviously when you're diversifying, you're looking at other options, right? So you need to understand, what is this market like? If you're diversifying from digital currency to Forex trading, okay, what's the Forex trading market like? What are the drivers of the Forex trading market? Because obviously the things that drive the Forex market are not essentially the things that drive the crypto market. As a matter of fact, the Forex market has more drivers of more factors that drive the market. And well, it doesn't matter, you can diversify and apply the same technical analysis on both. So the fourth thing you want to do is to develop an asset allocation plan. How much do you want? How do you want to, balance and allocate your assets to different, or your accounts to different assets or different instruments? Fifth thing you want to do is to invest in different asset classes and markets. So there's this popular saying, don't put all your eggs in one basket. You want to look at multiple options, and that's what we mean by diversifying. There's this saying by Harry Markowitz. He says diversification is the only free lunch in finance. And the sixth thing you want to do is to rebalance your portfolio regularly. So you want to cross-check your portfolio, which assets are making good money, which assets are not moving, which, you want to look at that at every point in time. If you're trading digital currencies, what digital currencies are you doing best at? What digital currencies are giving you great profits, and you can rebalance and, improve your portfolio from there. And the last thing you want to do is to seek professional advice. And this may not actually be the last thing, but it can come in as you're trying to diversify your investment portfolio. So you can seek professional advice from a mentor, an expert trader. At OctaFX, we have expert traders as well that can be assigned to you depending on your rank when you make a deposit. So you can take advantage of that and, get talked to, get checked on by these expert traders with OctaFX, and you can get the professional advice you need to diversify your investment portfolio. Now, remember, guys, there are a lot of things you can trade in the Forex market with OctaFX. You can trade currencies, you can trade metals like gold, and whenever they say metals, the first thing that comes into your mind is gold. But you can also trade silver as well, as a metal, and it's similar with trading gold, right? With digital currencies, you can trade the digital currencies that are paired with USD. You have BTC, ETH, multiple currencies, digital currencies that you can trade with OctaFX. And as a beginner trader, remember that you need to first start with a good number. You don't want to just go straight to start trading 10 currencies, 10 digital currencies. You want to start with major currency pairs that bring about high volatility, so you get familiar with the movements of the markets quickly, and then you can take it on from there. So guys, if you've got questions, here's the time to ask questions. I'm going to take a few questions and we can wrap up for today. Are indicators helpful? Of course they are, but you need to know how to use them. And it's not ideal to trade indicators in isolation. So you're not just going to base your trading decision, I want to buy gold because RSI tells me to. No, you can look at the market structure, support and resistance levels, key levels. You can look at fundamentals. You need to have, the more confluence you have, the more confluence you have, the more confident you'd be and comfortable you'd be to place the trade. What's the best time frame when you're a day trader? It depends. You can look for entries on 15 minutes and 5 minutes time frame, but you can't just neglect the higher time frames when you're a day trader. I'm not saying you should place trade on the higher time frames, but you need to use the higher time frames to know the overall direction of the market. Because if you're using 15 minutes, the markets can be moving in a downtrend in the 15 minutes, and that may not even be up to 10 candlesticks on the 1 hour time frame, right? That can mean, or may not be up to 10 candlesticks on the 4 hour time frame. So it's important to look at the lower time frames as a day trader, yes, for entries, but also pay attention to the higher time frames for the overall direction of the markets, because it's smoothing out. The higher time frame is going to give you like a clear direction. Okay, is it going up? Is it going down? On the lower time frame, there's going to be a lot of noise. So when you see that the higher time frame is saying up, you can now go to the lower time frames and identify your entries to trade in that direction of the higher time frames. My third time returning. Welcome back and thank you for joining. All right, guys, I'm going to wrap up right now. It's been an amazing session. Thank you guys for joining us. It's been 2 hours and you guys have been amazing. Remember that you can double your deposit if you use the promo code Ambrose E100. It's going to expire, or it's valid until tomorrow. So you can take advantage of that quickly, scan the QR code or manually type it when you want to make a deposit. To get the trading app and start trading, and also to create a trading account, you can click the link in the description. You can also check the playlist if you want to, watch more educational videos from OctaFX. The English playlist is going to be in the description. And remember, guys, while you learn how to trade and while you try to, create a source of income for yourself, you can also diversify. You don't just trade currencies with OctaFX. There are stocks you can trade, there are indices, there are commodities, there are digital currencies you can trade to make a profit from the Forex market. There's this quote by John Templeton. He said, the best way to minimize risk is to diversify your investment. So I hope that you guys learned something today. I hope you guys are going to put into practice, and I'll see you guys soon. Thank you for participating.